Good morning, everyone. You are watching live Daily Market Outlook prepared by Windsor Brokers for Thursday, 17th of January 2012. Rather quiet markets during the overnight session, with most of the instruments consolidating their recent movements, with the more significant comments from fundamentals showing that U.S. economy expanded in the recent weeks, according to the Fed beige book that was released yesterday. A moderate or modest pace in recent weeks, with consumer spending picking up. The Federal Reserve announced that some improvement is seen, and suggests that little change in terms of the recovery's strength is seen now. The U.S. Central Bank painted a cautiously positive picture of an economy gathering steam across its 12 districts, although businesses and consumers were worried due to uncertainty over fiscal policy and conditions on the other side of the Atlantic. U.S. lawmakers agreed to hold taxes down for all American families who earn less than $450,000 US dollars per year, but must still negotiate an increase in the U.S. debt ceiling, and the measures to set aside deep automatic spending cuts currently due to bite on March 1st. This is also related to yesterday's Fitch comments that they might downgrade the U.S. AAA status currently that the United States have due to this debt ceiling that has to be agreed in the next meetings. During the night, releases showed that Australia's unemployment slipped in December, while with the rate cut expected to be seen according to the recent releases and the action of the Australian Central Bank in the next meeting. As we said, the employment fell unexpectedly in December, and nudging the jobless rate up to 4.5%. This was according to the forecast, but still above the 5.2% of the previous release, showing that the Bank of Australia might be acting again and doing something, especially we're talking about rate cut that is now expected based on the current situation in the Australia. The comments from European Central Bank Novotny that Eurozone will stay contracting during 2013, and some improvement could be seen only at close to the end of 2013 and beginning of 2014, confronted 2 days ago other ECB of European Eurozone official Jean-Claude Juncker, who said that basically the economy would start picking up in 2013. Gave some boost to the single currency, but still the single currency still within the range, stayed below the range top at 133.30. The comments from the Novotny is basically as what I said, that exchange rate is not a great concern right now, and more focus should be seen on the economy. That will result in the short-lived bounce in the current improvement, with more significant signals of improvement according to Novotny and his expectations to be seen in the last quarter of 2013 and the beginning of 2014. The market's Asian shares moved a bit higher, modestly higher on Thursday, consolidating amid better than expected yesterday's U.S. earnings, but demand was capped by caution ahead of Chinese data. We have Chinese data on Friday. GDP as the most significant among the retail sales, and the most of investors now are looking for a release of this data, being cautious at this point. Dollar and euro remained steady against Japanese yen after two days selling. Basically, dollar regained some ground against Japanese yen, bouncing to the levels above 88.00, while the Cable remains around the 160 zone, capped by 160 zone, still sideways mode, consolidating recent losses, and a brief break below important 160, 159.90 support. Dollar Swiss jumped in the beginning of European session, breaking above the recent range after clearing 93.00 as a key near-term barrier, with 93.30 seen so far. 93.55 was the highest seen this morning. Opening prospect for possible further extension higher as the pair cracked 93.45 Fibonacci level. Briefly about oil, that stays in the range trading, but the near-term structure is still aligned towards the upside as the price holds above 94 and more significant 93 support, with the action being underpinned by ascending 55 days exponential moving average, and the gold is consolidating recent gains, holding still below recent high posted 2 days ago at 1684. Again, more positive tone is seen, focusing the upper barriers 1694 and the 1700 seen in the near term. And from today's calendar, lack of any volatile data sees, just to mention that releases that we already commented of from Australia, employment change dipped by 5.5 thousand compared to increase of 13.9 thousand in November, and 2.3 thousand increase forecasted today. Unexpected drop with the unemployment rate jumping to 5.4. That was according to the expectation, compared to 5.2 in the month of November. Swiss producer price index for December came at 0.1%, slightly better than the previous release, but below the forecast of 0.2%. European Central Bank monthly bulletin is due at 9 o'clock GMT, and that will be all from European side. Americas start at 13:30. Canadian foreign securities purchases see the decline, drop in the purchases to 9.45 billion Canadian dollars according to the forecast, compared to 13.26 billion Canadian dollars seen in the month of October. And United States weekly release of weekly jobless claims, 369 claims forecasted for today versus 371. That was the previous week release. Slight improvement, not that significant according to the forecast. 1330 are coming also the U.S. building permits for December, 910,000 permits forecasted for today compared to 900,000 in the month of November. And the housing starts are expected to tick higher according to the forecast of 890,000 new housing starts compared to 860,000 in the month of November. And at 1500 GMT, Philadelphia Fed Manufacturing Index for January expected to drop to 7.1 according to this forecast, compared to 8.1 in the month of December. And natural gas storage comes at 1530 GMT. We have no forecast. 131 billion cubic meters is seen in the previous week. And finally, late in the afternoon, fourth quarter inflation for New Zealand is, according to the forecast, it's going to grow by 0.1% compared to 0.3% in the third quarter. And that was all from today's calendars. Technicals are coming now. We're going to see the latest technicals for the major currencies and commodities. As said, most of instruments spent their Asian session trading time within the range. Euro is showing some signals of improvement, as shown on the hourly chart, as a temporary base was found at 132.55 on a pullback from 134.01, with the upside being widely capped by 133 zone. We had some peaks higher at 133.23. This was yesterday's high, with the early morning European opening session seeing some fresh strength attacking the upper boundary of the current sideways movements. Just to mention that support was found at 132.55. It's close to 38.2% Fibonacci retracement of the latest uplift from 130.37 to 134.02. More expectations was seen towards the downside based on the still negative 4-hour structure as descending indicators. However, the now action in the beginning of European session shows something opposite, but still we need to see the clear break above 133.23 as minimum required gains in order to avert immediate downside risk, and probably to signal basing attempt at 132.55, signal higher low, that confirmation of which requires a move above approximately 133.35, 133.50. That will shift focus again towards the recent peak at 134.02, fresh 11 high of euro dollar. Now improving structure on the hourly chart as some momentum has been regained on the recent bounce higher, and all the other indicators starting to point higher. MACD is about to break above the midline, showing potential for some stronger recovery. However, as I said, clear break above 133.23 is required to confirm this action. Otherwise, we'll be still seeing the pair moving within this range with the still negative, with this still descending 4-hour indicators as MACD approached now the midline, and momentum is already below the midline. Seeing still more pressure towards the downside, some improvement seen on the RSI that moved above the 7 days moving average and starting to point higher, along with the momentum 14 attempting above 7 days moving average. Again, all these require a break above initial 133.23 and 133.35 in order to confirm a basing attempt and the open way for possible stronger recovery. Conversely, sterling remains under pressure following a break below important 160, 159.90. Some bounce seen at the beginning of European session after the pair dipped yesterday to 159.74, just ahead of 159.60. Our next downside target and the Fibonacci support. Still the negative tone continues to dominate. The pair now broke above 160.00 briefly, but we still need to see some more moves higher in order to signal to avert immediate downside risk, I would say, and look for further recovery of the pair. 55 days exponential moving average currently at 160.30, along with the previous lows, offer initial and quite solid support resistance for now, and this requires break minimum of minimum this level in order to pick up recovery and look for some stronger bounce higher. Otherwise, this could be described as corrective consolidative action preceding fresh weaknesses. We are still in the downtrend in the near term from 161.77, especially in light of clearing, briefly breaking previous strong support and lows at 159.90 and 160.00. That would open prospect for some stronger losses, as the indicators on 4-hour chart are well in the negative territory and seeing a room for further extension higher. As said again, unless we see break above minimum 160.30 and 160.50, I would say at this point, that marks approximately 38.2% of the recent down leg from 161.77 to 159.74, and not much to be expected of the current bounce higher. We are still congested below the or around the yesterday's intraday high at 160.16, 160.16 exactly seen so far. I would say so far this is still seen as consolidation, unless we see the break above 160.30 and 160.50. That may open way for some stronger recovery. However, a break above 161.00, previous congestion top and high of 15th of January, as well as 61.8% retracement is required to shift focus towards the upper barriers at 161.54 and the final one at 161.77. Near-term structure is still holding a quite a negative tone and still sees more potential towards the downside, especially that we lost briefly the 161.59. Support with the daily indicators now breaking into the negative territory, and most likely it's a continuation of the larger down move from 163.80 peak of 2nd of January. Would look for 159.60, 76.4% retracement of the uplift from 158.26 to 163.80, and then also the low of 28th of November, pardon, and then the more significant 159 round figure and the 200 days moving average. The dollar yen regained some ground, recovered some of the recent losses on a bounce from yesterday's low at 87.78, where the temporary support was found. This also marks 23.6% of the larger 87.71 to 89.66 rally, with the dips mainly being contained by 55 days exponential moving averages. A brief dip below this, and the recovery proved that this was a false break. So its near-term structure is now supported by 55 days, 4-hour 55 days exponential moving averages. Bounce from 87.78 yesterday's low, retraced over 50% on its bounce to 87.78, over 50% retracement at 88.78. This was overnight's fresh high. Outside this point, more focus is seen towards the upside, as hourly studies are slightly above their midlines, and seeing potential for some further recovery. Of course, break above yesterday's high, overnight's high at 88.70, and then the more significant 89 zone resistance. These are the highs of 15th of January, and 61.8% retracement would give more credibility to the current bounce higher, and would signal again the possible return up towards the recent peaks at 89.62 and 89.66. Will confirm the higher low at 87.78, and look for a continuation of the larger uptrend. So far, according to the 4-hour chart, that still maintains a negative tone. It seems that the correction is not over unless we see the break above 89.00. That will refocus upper boundaries. Otherwise, a risk would be seen on the lower top below 89.00, and possible fresh extension lower, according to the current outlook on the 4-hour studies. Daily structure again overextended the conditions on all indicators, and reversal of stochastic again are seen supportive for a possible stronger corrective action that hasn't been seen since the rally started at 77.42 sometime in September, and peaked at 89.66 3 days ago, with some stronger corrective action not ruled out at this point. Still, we can see the daily indicators are slightly pointing lower, with the stochastic already reversing down, and the RSI attempting to break out of the overbought territory. That could be a signal for some further corrective action. On the downside, we have immediate support at approximately 12.88.00, and then 87.78, the break of which would be seen as a trigger for some stronger corrective action. And according to the, we just need to see something. According to the studies, Fibonacci reversal from 86.81, that is approximately here. We might be looking for a correction down towards 87.50, extension towards 87.50. That marks approximately 76.8%, 76.4% retracement pattern, and then comes 87.00 round figure, and the most significant 86.81 low of 9th of January 2012. As said, near-term structure is still maintaining positive tone following bounce from 87.78, but the gains require break above 89.00 to confirm the recovery and avert possible risk of reversing down. We are congested basically now below 80 88.78, but a quick recovery following overnight's dip down to 88.12. Still see potential more towards the upside as slight improvement seen on the hourly chart studies. And dollar Swiss jumped above its near-term congestion at congestion top at 93.30, extending gains so far to 93.53. With quick recovery now, seeing this as probably false break. We have to see. Bulls are still in play on the hourly and the 4-hour chart with the recent congestion seen as just consolidation of the stronger rally from a 91.00 higher base and possible continuation of the uptrend is seen on a clear break above 93.30 and 93.45. That marks Fibonacci 61.8% of the downleg from 93.45 to 95.11 to 91.09. That will open way towards more significant barriers. 93.81 high of 7th of December 2012, and 94.00 is around the figure resistance, close to 76.4%, above which we have 94.30 previous highs, previous double top, and the 200 days moving average. So far, the near-term structure holds a positive tone, though the quick reversal from a 93.53 recent high posted earlier warns of possible stall of the current rally as the pair now dips below the recent range top. We have to see basically loss of 93.00 and the 92.84 that marks the recent range floor, and this is reinforced by ascending 55 days exponential moving average on the hourly chart. Would be initial signal of possible further weakness and retracement of the recent rally from 91.09 that peaked so far at 93.53. Holding above 93 again will keep the focus towards the upside. As we said, the hourly structure is still positive, and the 4-hour indicators holding in the positive territory. Still see potential for further stretch higher and possible extension towards 93.81 and 94.00 our next upside targets. Of course, if 93.00 and 92.84 lows hold the downside. Crude oil, no big changes from yesterday, though the near-term structure is still aligned towards the upside as the price regained the 94.00 and now aiming towards recent peaks 94.42 and 94.68 seen as the next upside targets. Hourly indicators in the positive territory and aiming higher are supportive for the current action, with the 4-hour chart also showing a positive tone now dominating. As the dips were contained by ascending 55 days exponential moving average, that basically keeps the upside action supported from mid-December 2012. Holding above this level currently at 93.26 keeps more focus towards the upside, and the possible break above 94.68 is expected to open 95.00 as the next upside target, and basically above this there is no many significant barriers. We have now around figure at 96.00 and 96.79 is 76.4% retracement at this point. 94 zone is seen as initial barrier, and but now basically the price broke above this 94.42 and then 94.68 are seen as the next upside target, with the positive tone seen also on the daily chart, and the near-term bulls, hourly bulls are now gaining pace, seeing potential for at least a retest of 94.68 for possible break higher towards 95 and then $96 per barrel on break. On the downside, break below initial support at 93.25. We said 93.29 currently the 55 days exponential moving average, and 93.00 is psychological support would risk further easing towards more significant 92.64 recent range floor that will sideline immediate bulls and keep the upside targets at 94, 68, and 42 out of reach in the near term. And finally, gold that is consolidating recent gains, holding below 1684 recent high posted on 15th of January, with the fresh action higher seen at the beginning of the European session after yesterday's dips were contained at 1673. I think we mentioned this support in our yesterday's comments as good support, and that should not be exceeded. This marks on reversal 50 Fibonacci 38.2% expansion of the uplift from 1653, with the upside targets, immediate targets seen at 1686, which is 61.8% expansion, and then the key barrier 1694 peak of 2nd of January 2013, and also this marks 76.4% Fibonacci expansion of the rally from 1653. Overall near-term structure for gold remains positive. The hourly indicators are now waking up from their flat and neutral mode, while 4-hour structure is still holding a firm positive tone, and see potential for a further stretch of the recovery rally from 1625 low of 4th of January. That will open our upside target 1686, as we said, 1694, and also very significant 1700 round figure resistance and psychological barrier, above which we have 100% expansion at 1706, unless the price breaks below 1673 and 1670, that marks 55 days exponential moving average. This is also the broken bear trend line somewhere around this zone at 1665. More focus will be seen towards the downside, towards the upside, pardon. Only break below 1665, and this also marks the previous consolidation range floor and the higher platform, loss of which would shift near-term focus again towards the downside. But at this moment, we are aiming towards the upper boundaries. Initial resistance 1684, and then 1686 ahead of 1694 and 1700 seen as a near-term target for the yellow metal. And that was all from our side for today, 17th of January 2012. I wish you a very nice Thursday, and of course good luck in your trading with a lot of profits seen in your accounts. Good luck.